How much do I have to buy to pay almost no taxes? That's a weird way to think, but commercial real estate gives you the ability to do that.
The 100% bonus depreciation is back.
Pause there so that nobody misses that. Somebody who's a brokerage owner, a commercial real estate broker, our friend down the hall, top producer Todd Humphreys.
Producer Todd Humphreys.
Buys $1 million building, does a cost segregation study on it. It identifies 25% of the value of that building is eligible for bonus depreciation. He can take a $250,000 loss, and if he made $250,000, it totally offsets that income, and he can get his taxable income down to zero.
That's exactly right. And this is exactly what the CRE market needs right now.
Yes. That being back makes commercial real estate way more attractive. So just this one thing could have a ripple effect.
But there's actually more than just this. You can get 100% bonus depreciation on the entire building if... Oh, and by the way, I left out the best part, guys. It's now permanent. Commercial real estate really needs this. Each state, they're in charge of picking their own zones, right?
You can pick your nose and you can pick your zones, but you can't wipe your zones on the curtains.
What we do with our clients, if they're in the highest bracket, we pick a number just big enough to get them down in the middle class bracket.
And there's like an extra pep in your voice. Does this get you really excited?
I love what I do. I have the best job in the world for me.
Yeah.
So a lot of these new deductions are for the lower incomes, and they actually did raise taxes on people in the highest bracket. When you hear the spin that this bill was only for the rich, it's not the case.
On one channel, they're saying one thing, this is all bad. On another channel, they're saying this is all good. Both not true. It's amazing that on our podcast, you are getting the truth.
Yeah.
All from Kevin Bassett. I'm getting excited too.
If you're new to commercial real estate investing, you probably know the feeling. Brokers, underwriting, raising capital, where do you even begin? And that's why CRE Investor Coach exists, to give new and emerging investors a clear step-by-step path to closing their first deal. I believe in this program so much, I actually joined the team as an adjunct faculty member. That's how committed I am to helping more people get into the space right now. Whether you want to go at your own pace with on-demand training, launch your first investment with expert coaching, or scale with a mastermind of other ambitious investors, there's a roadmap here for you. Inside, you'll learn how to define your investor identity, analyze deals with confidence, talk to brokers like a pro, raise capital, and build a real acquisition pipeline without all the guesswork. This is about building a business that blesses your life, not breaks your spirit. So if you're ready to stop spinning your wheels and actually get in the game, check out the link in the show notes and start your journey today. Learn, launch, and scale with CRE Investor Coach. This episode is also brought to you by Site to Do Business, commercial real estate's most advanced toolkit, providing commercial real estate professionals like me with premier data, mapping, and marketing tools to win business and revolutionize decision-making. Visit stdb.com to learn more.
Welcome to Commercially Speaking, the only commercial real estate podcast hosted by a former Marine turned CRE mogul.
And his little brother, a left-handed theater kid who once tried to write off a puppet as a dependent.
That puppet had expenses, Bo.
Hey man, explain it to your CPA.
Well, speaking of, today's a big one. We're live, we're talking taxes, and we're diving into a topic that's already stirring up a CRE group chat.
Trump's big, beautiful bill.
Now, hold on. Before we go any further, yes, our dad's name is Bill. Yes, he's big.
True.
Yes, he's beautiful.
True.
This is not that big, beautiful bill.
Correct. Different bill. Less Florida condo board meetings, more legislation.
Also, side note, BBB could just as easily stand for my beautiful brother, Bo.
Big brother Bo. It was right there.
Yeah, okay. Either way, this bill has major implications for commercial real estate pros and investors. And since Barbara Corcoran is still not returning my calls, today we brought back the one guy who can break it down so even I don't have to fake it.
He's the CPA behind some of the top investors, brokers, and syndicators in the country, and I've got him on speed dial.
Please welcome back for the fourth time, the man, the myth, the margin optimizer, Kevin Bassett.
Thanks for having me, guys.
Welcome.
Yeah, thanks so much. Always fun to be back with you guys.
Big news. Big reason.
We got stuff to talk about today.
Yeah, a lot going on. And frankly, I hadn't been tracking it much because I knew that when it happened, we'd have you on and you'd teach me all about it. So what's going on with this big, beautiful bill?
Yeah, well, I won't get I'll stay out of the political and all the stuff that isn't related to tax. We'll stick with the tax, but the one thing I will point out is this one was incredibly close on the votes and wouldn't have gotten through if some things hadn't happened, including it wouldn't have gotten through the House of Representatives the first time had not 3 Democratic Congress people passed away between the day they were sworn in and the day that they voted on this bill. That is a crazy
Really?
piece of trivia that, the best of my knowledge, has never happened in my career.
3.
Pretty wild.
I did not know that.
Well,
3, yep.
Now
I didn't know that at all.
the conspiracy theory part of my brain is now kicking into overdrive.
Yeah, there'd
Be
be
a
some
book in
chatter
there.
on that. And you listen to different news channels, you'll have different opinions, but we'll try to get the facts out today.
I know you just did a webinar on this. I caught the end of it from an airport a couple days ago, so I know you're teed up to just roll. But the one thing I was waiting for, the one I feel like impacts maybe the industry the most from a brokerage angle or an owner's angle, is this 100% depreciation. So maybe start there if you don't mind.
Yeah. Let's start with the depreciation stuff and hit the real estate. So as wildly anticipated and really, really desired by the real estate community, the 100% bonus depreciation is back, effective January 20th of this year. So they chose to use the president's inauguration day rather than January 1st, like these other provisions. And what it brings back to the game, to the creative real estate industry, is the cost segregation strategy, which I'll talk about. So this 100% bonus depreciation is, I don't know, been around with in different forms in the past from at least 3 different presidents of different parties. And but starting in 2018, we had it, and that was a good time for real estate, and it continued for a while. But the last 3 years, I believe, it's been phasing out. Went to 80%, then 60%, and then 40% is what it was scheduled for this year, and it was going to go away next year. And it's back at 100% effective January 20th. So if you buy a piece, bonus depreciation allows you to do is generate a tax loss, right? It takes some of this business property and makes it fully depreciable in year 1, even if you don't have profit, unlike the Section 179, the other way you do depreciation. So with the way it works in cost segregation, if you have a real estate LLC and say you buy $1 million building, you pay a company to come in and do a cost segregation, and they generally identify between 20 and 30% of that building as eligible for accelerated depreciation, or in this case, bonus depreciation. So that means you buy $1 million building, you get a $250,000 tax deduction in year 1, which is huge. So you can invest in a real estate project and get a K1 with a huge loss on it. And if you're a real estate professional, which most of the listeners on this podcast are, it can offset all your other income, regardless of what kind. If you're not a real estate professional, it just offsets other real estate income. But if you're a commercial brokerage, you are a real estate professional, most likely.
Yeah,
good
so
stuff.
Let me just pause there so that nobody misses that. Let's say somebody who's a brokerage owner, a commercial real estate broker, our friend down the hall, top producer Todd Humphreys,
buys
$1 million building, does a cost segregation study on it. It identifies, let's just say, to use your example, 25% of the value of that building is eligible for bonus depreciation. Essentially, he can take a $250,000 loss that year because he bought the building. And if he made $250,000 commissions, income, whatever, it totally offsets that income, and he can get his taxable income down to 0. Like,
That's exactly right. Yep.
That's how it works, correct?
That's exactly right. Yep.
So there's a ton of power in this.
It is. And additionally, if you're doing, for folks out there that might be doing syndicates, say they're doing a large building, they're going to bring in investors. It's not unusual that they would get a K1 for, say, 80% or more of their investment, depending on how much debt you have in that project. So you have clients in the past that they invest $100,000 in a real estate project and get a K1 loss of, say, $80,000 or more in year one, that makes it attractive and easy to attract capital. So we really, all in all, it's going to seriously reduce the cost, the after-tax cost of investing in real estate. And this is exactly what the CRE market needs right now,
Yes.
Badly. But there's actually more than just this, believe it or not.
No,
There's a new thing in here. There's no IRS guidance yet, and we can't wait to dig into it. They have added another category where, as the bill's written, we're going to have to see, what the guidance is, that you can get 100% bonus depreciation on the entire building if it's a manufacturing building, i.e. a factory. The meat's going to be in the details on this one, but does that means instead of them identifying 25% of eligible depreciation and getting $250,000 loss, in theory, you buy $1 million building, you can get a loss for the entire building piece. I'm sure not the dirt. I think when the guidance comes out, that won't be the case. But can you imagine that turns that $250,000, deduction into something much, much larger? We can't wait to see the details. And hey, does that does that include outside investors or just the operating company, the factory? Can't wait to see. So it could potentially spur a lot more, a different, slightly different asset class, commercial real estate.
So Timmy, think this through.
Yeah. Okay.
We shall see.
This is for manufacturing, specifically factories. Is that what you said?
Factories would be an obvious example.
Yeah, they call it manufacturing building, which is code for. Yeah, so I don't think they're going to say, hey, Bassett and Associates is manufacturing tax returns. That would be fantastic. I'm pretty sure that's not the intent of the law, and that's not what the guidance is going to say. But as you know, there's this big theme that's been going on, and particularly with the current administration, of bringing manufacturing back to the U.S. So what they're trying to incent is people to plow capital into building factories now and getting not just the bonus depreciation the way we know it, where 25% of the building is eligible for it. They're trying to make the entire building eligible for bonus depreciation.
So if
there was no dirt on your $1 million building, I'm sure there is.
Yep,
that would be $1 million deduction.
Okay, good.
All right, Bo, explain.
Well, imagine if when we launch Hearthstone Fund 3,
okay,
and an investment, like an investor owner of a manufacturing building, can take this. Like, we don't know yet, but imagine the amount of tax shelter we could create through that kind of group mix. Because right now, like what he was mentioning before, I've had people invest with me, and I give them a K1, like he said, of like 70-80% of what they invested with me, and they're thinking, hey, wait a second, you actually sent me some distribution checks this year, which means it made money, but you're showing me I lost almost all my money. Like, I've had that conversation a couple of times.
Right.
Exactly right.
And yes, it looks like that on paper because of the bonus depreciation. You can shelter more of your income. Ooh. This would just seriously amplify that.
Yeah.
And make
it would.
Kind of property so appealing.
And now, like, this, what is happening right now is what a lot of commercial real estate professionals were hoping would happen with this administration to some degree, but it sounds like it's even, it's nuts, right?
Nuts. Yeah. I like that. Nice soundbite.
Yeah. And what would this mean if it is able to be taken by the investors, and you say you're fun and you guys did invest in some projects, they could, what we're talking about is they would invest their $100,000 and get a K1 with more than $100,000 loss. Because with the way we've got your structured, you get debt basis too. That would be a first time ever situation, right? In real estate. This is the only other thing comparable is something called Section 181. So Timmy, this is your old profession where you invest in films. That there you can get a loss higher than your investment. But this would bring that into the real estate arena, and that's the only way film has been able to attract capital.
Let's talk about that for a second. No, I'm kidding. Go ahead.
Yeah.
That's what might happen here. Is this would seriously attract capital?
Yeah,
and I wonder if it'll have an unintended consequences that it really drive up the price of manufacturing real estate. I wonder. Well, we can talk about that another time. But
that's always an interesting question, particularly if a lot of factories need to be built at one time. That would have been true anyway, right? The demand. Yeah, very very interesting. I'll tell you what, creative real or commercial real estate really needs this. So real estate did well here. Bonus depreciation number one. I think that's going to be the most used. This bonus depreciation on manufacturing is a huge deal as well. The other interesting thing is opportunity zones are getting renewed. Those all expire the end of next year. So there's going to be a new round of opportunity zones starting in 2027. And that doesn't do us any good this year or next year, but it'll do us a lot of good. So let's make sure we meet on the podcast before then. And that's going to allow them to, just like when the first round came out, defer gains, in this case, all the way to 2033. And then some of those gains will be completely tax-free. Some are deferred and some tax-free. And then if you make money in the opportunity zone, keep it at least 10 years, then that's forever tax-free. And they have slightly updated and simplified the rules now that, you know, the stuff they learned from the first round of zones. And this one's got bipartisan support, should be around. But this has been, expected for some years. They was hoping it would pass in the previous administration, but did not. But now it is. So 2027, everybody mark their calendars and do some OZ deals.
All right, let me ask a quick question then. I forget what opportunity zones are. So can you give me like a brief?
Yep.
Yeah, let me give you like the 30-second version, because this is probably complicated enough to be a whole episode, and I don't want to get bogged down here since we have a limited amount of time with Kevin today. But opportunity zones, essentially, states identify places, like literal geographies, low-income areas, that they want to incentivize people to come in and develop and improve.
Yeah.
And they basically say, okay, here's these areas. And if you come in and purchase and improve property, the way it was before, if you bought something for $1 million, I think you had to spend another $1 million.
Yep, the old rules. Yep.
And the new rules, I think, are going to be a little bit easier, because that was a tough. That's basically what I looked at doing some of that, and I was like, man, I don't want to.
That's right.
Yeah.
And then if you do that, you can, the money, instead of 1031ing into some other property, you can not really 1031, but you can take your gains, put it into an opportunity fund that goes into an opportunity zone, buys a piece of property, improves it, and you can defer taxes for a specific amount of time. And if you hold it for another amount of time, it becomes somewhat tax-free on the gains. And there's just, it's a nice deal.
Yeah.
It's a little bit complicated, though.
Yeah. Okay, cool.
But it's a way for states to incentivize development to go into specific areas that they want to see improved.
Gotcha. Okay. Yeah. Thanks.
Right.
Yep, exactly right. And so those are getting renewed. And so the states will need to come up with their new opportunity zones by 2027. As Bo said, each state, they're in charge of picking their own zones, right, where they want things improved.
You can pick your nose and you can pick your zones, but you can't wipe your zones on the curtains.
That's right. Exactly.
Dad's really going to appreciate that one.
That's
the Bill Barron.
That's for our big, beautiful Bill.
That's right. That's right. Beautiful Bill. All right, what's next?
Well, so those are good things. One thing to be aware of that's time sensitive is, as a lot of folks know, there were energy credits. There were the electric vehicles, and these were all, and then energy credits related to buildings, both your personal home and real estate investments. So what they did and came in, and I'm sure there's some politics with it, is those are scheduled to go for years, and instead they're ending soon. So I'll just quickly mention the vehicles, just in case anyone's in the market. All of the electric vehicle credits are ending September 30th of 2025. I personally don't have an electric vehicle, but I do know some of our clients, have them either personally or they're electrifying some of their fleet, particularly whether it's salespeople's calls or delivery vans. I've seen those. So I would say that if someone is in the market for it, if that type of vehicle is appropriate for them, strongly consider getting them this quarter, really for three reasons. One is prices are down. Secondly, you've got these credits about to expire, and they're a lot of money. They're like $7,500.
Wow.
And third, you got bonus depreciation. So if you put those three things together, you can get an electric vehicle. Your after-tax cost is extremely low. So if it's appropriate, you've got to do it this quarter. That's a tight timeline.
Is this one of the reasons why Elon Musk is so pissed off because the energy credits are going away in September?
I was going to ask if it's because he got pissed off that the energy credits are going away in September.
You do wonder, yeah, yep, exactly. And I'll tell you, we everything's interesting this year, isn't it? Everything's interesting. So,
Oh my God.
so yep.
Yeah.
And,
Elon Musk is all like, say what again?
but I don't think anybody really thought that love fest was going to last long. But anyway, yeah, so that's the vehicles. And yeah, so tight timeline. So if that's appropriate for you, get on it quickly. The other one though with the buildings, first there's things with the homes. You can do home improvements, and those are worth some money, and you can get some energy efficient home energy, whether you're adding solar or we've had a couple clients do geothermal, and then those are expiring the end of this year. And then if you're buying a new energy efficient home, you've got to have that completed by June 30th. Same thing is true with commercial real estate. One of the most popular energy credits, which predates the Biden administration, it's been around forever, and that's Section 179D. And that's when you're adding, doing some improvements to make your commercial building more energy efficient. It's been around forever. We've been doing it with our real estate clients as long as I can remember. And that is actually expiring. So that was not a Biden administration thing they're getting rid of. That's an old thing. And so that all ends December 31. And if you're doing a new energy efficient commercial building, it's June 30th. So if you're doing something to your personal home or existing real estate investment, that ends December 31, 25. If you've got a new home, energy efficient home, or a new energy efficient commercial building, that you got to get that done by June 30, 2026.
Okay.
Those are our deadlines.
Now, I was reading about Section 179. Was it not expanded, though, overall?
Yeah. So Section 179, just brushed over briefly with bonus depreciation. So that's the old first year depreciation rules that have been always in existence. My career, the difference is the amount you can do has gone way up. So what this says is if you have, whether it's a real estate or you have a business, so if you're, say, your commercial real estate brokerage business or any other business you have, if you buy business assets, you can do first year depreciation up to either their limit or the amount of profit you have. Now, when I started my career, I think the limit was like 25 grand, and I don't feel like I'm that old. And then this past year it was 1.25 million. Well, they jumped it up to 2.5 million. Really huge. But that assumes you have enough profit. So if you got $1 million of profit and you buy $2 million worth of stuff, your limit's that $1 million of profit. And that's how it's different from bonus depreciation. So the two big differences between the Section 179 and bonus is, number one, bonus depreciation can give you a tax loss. 179 can take you to zero, right? And then any overage can carry forward. But why would you do 179 versus bonus? There's really two reasons. With 179, you can pick and choose which assets you're going to do this with and how much, right? You can pick the amount. Where with bonus depreciation, all of your 5-year or all your 7-year property has to be bonused, right? You can't pick and choose the assets, and if you pick that asset class, if you pick bonus, you got to depreciate the whole thing. 179, you can pick your number. So what we do with our clients, if they're in the highest bracket, we pick a number just big enough to get them down in the middle class brackets, right? Because we don't want to waste the low brackets, because then they can carry forward and continue to use that depreciation. So we do that. The other reason is sometimes you don't want to take a truck and take it to zero when you still have a loan on it. And the third reason is many states don't recognize bonus depreciation, but they do recognize 179. So 179 gives you federal and state deduction. That's better than just federal. So we aim to be strategic with our clients on this. So now we got two great tools in the toolbox, and somehow maybe a third for anybody that buys a factory.
Kevin, you sound there's like an extra pep in your voice today. Like does this get you really excited?
Oh yeah, my brains are always going. I love what I do. I have the best job in the world for me.
Yeah,
So
right.
for
you.
me.
Yeah.
Well, it sounds to me like bonus depreciation is more like a broadsword. Like you can really knock stuff down with it. And Section 179 is much more like a scalpel.
It really is, yeah. And with the businesses. Now, bonus though, bringing cost segregation. Oh, and by the way, I left out the best part, guys. It's now permanent, right? So it's not sunsetting. They don't need something to expand it. Now, if the blue team comes in and goes 3 for 3, they can do whatever they want.
Right.
But it is permanent. So the cost segregation companies are literally. They probably haven't stopped having cocktails.
Oh my gosh. Hold on. This is for you, Rod.
I'm excited, Bo. I'm so excited.
Hey, Rod.
I'm excited too.
Yeah.
Yep, you can tell I am. So.
All right. What else?
So that's the good stuff with real estate. Always good to start with that. Kind of the other big things, really the biggest thing that this bill accomplished with every taxpayer is it took the tax rates that we've had since 2018 and extended them and made those permanent. Because these came into effect in 2018. They're scheduled to expire at the end of this year, end of 2025, and in 2026, had this bill not passed, we were going back to the tax rates that had been passed during the Obama administration, and that was going to drive up all brackets, despite what you hear on some channels and where they say it's all just going to rich. That's untrue. And then of course on another channel, you're going to hear that this thing is perfect, and that's not true either. But what the 2018 rates did is it brought the rates down for everybody and stretched out the brackets, right? You go up in a bracket at a higher income than you would have in the past. But from a percentage basis, really it's those under 100,000 and then what's called the middle class brackets between that 100-some thousand and 400 that are getting the highest percentage savings. Now those in the highest bracket, they're you add them all up, that's the most dollars, right? Because someone's making $5 million and you're knocking 2.6% off the rate. It's a lot of money. So that's the big thing it accomplishes. The other massive thing for my clients is something called Section 199A. And what this does, if you have a business or real estate income, if you qualify for these rules, 20% of that taxable income is tax-free. So that is a huge deal. And so, and again, that's businesses if they're not what's called an SSTB. So the only one that doesn't get it is certain professional service firms like doctors, lawyers, and yes, your favorite CPA. I don't get it either on my K1.
Really?
On that business.
Ew.
Yeah, it hurts my feelings. It means we have bad lobbyists, but the almost every other business
You
does.
would. I think accountants would have
Yep.
lobbyists. Yeah.
Yep, exactly. Not exciting enough. So that's a huge deal. So that means if you're in the 37% bracket, the high bracket, and you knock 20% of your K1 income off, that brings your effective rate down from 37% to 29.6. That's a huge deal.
That is.
And the idea was they're trying to make these S corps and partnerships competitive with C corps that have a 21% rate, and that was permanent, and that's still in effect. So this is a huge deal.
Now, is this Section 199A thing, is that what we're talking about when you talk about QBI?
Yep, QBI. Yep, QBI is the term used for Section 199A, and that's qualified business income.
Okay.
So if you get a K1 from a business that qualifies, which most do, 20% is going to be tax-free. And also if you get K1 from a real estate entity, or you have a rental right on your tax return, if that's a profitable number, right, a positive number, 20% of that can be tax-free. And so it's a big deal. And some REIT income, by the way. So having that come through, because that was scheduled to expire at the end of 2025, but it is it's safe, and it's permanent.
Wow.
Yeah, baby.
This is crazy because on one channel, like you said, they're saying one thing, this is all bad. On another channel, they're saying, this is all good. Both not true. It's amazing that on our podcast, you are getting the truth.
Yeah.
This is the truth. All from Kevin Bassett. He loves
Thanks.
stuff. Excuse me. I'm getting excited too. All right. All right.
Yeah.
Deep breath.
Now, some other interesting things. These are the main business stuff, and we'll continue to talk about it. There is other things that affect those that are not in the highest bracket, and I'll kind of quickly go through those and these can affect whether it's our listeners or our kids. Listeners' kids that are getting started out with lower income. So one thing they did is that the big standard deduction, that's extended, right? Same rules, and that's not going away. We don't have to go back to that. And what that means is if you don't have to itemize and you get a big standard deduction. If you're single, it's $15,750, and marriage is $31,500. So that's big. But he's got these new deductions. Yep. Got these new deductions, and I call these the giveaway. So we had kind of a populist part of the campaign last year, if memory goes back to it, where there was the two candidates were we're going to give away this, we're going to give away this, and they called it the big Oprah giveaway. Yep. And so a bunch of things were promised by both sides, and one of the first ones the president said was, hey, Social Security is going to be tax-free. The only problem with that is that fiddles with a Social Security trust fund, and you can't do that under reconciliation. You'd actually need the 67 votes in the Senate. That wasn't going to happen. So what they did instead is they came up with a senior's deduction. So anyone that is 65 or older by the end of the tax year, this is effective this year, you can get a $6,000 per senior deduction on the tax returns. They can't make the Social Security tax-free, but they're going to lower the taxable income for the seniors. So if you got two married seniors that are each 65 or older as of December 31, 2025, that's $12,000 that's just going to get knocked off their tax return from the taxable income.
Nice.
That just lasts, it's only going to last for 4 years. So 25, 26, 27, and 2028. In 2029, it goes away. And their income needs to be below $75K if they're single and $150 if they're married. So again, this isn't for the rich, that's for seniors below those income levels.
Cool.
They also raised child credits and dependent care credits. That had kind of been in the work in both parties for a while, because the child credit used to be higher during COVID. But then the other thing promised back then was the no tax on tips and overtime.
This episode is sponsored in part by Site to Do Business, the ultimate commercial real estate data analysis and mapping tool. Whether you're a seasoned professional or just starting out, Site to Do Business provides the data and insights you need to make informed decisions and close deals faster. Frankly, it's the tool that I use the most in my business. Access comprehensive market analysis, demographic data, and powerful mapping tools like ArcGIS, Placer AI, and flood maps all in one place. Identify the best locations for your clients, analyze market trends, and present your findings with confidence. Don't miss out on this game-changing platform. Visit stdb.com today and see how it can optimize your business. And now back to the show.
So here's how these work. Again, those are just 4-year deals, 2025, 26, 27, 28. So they are in effect this year. So on tips, you can get a deduction up to $25,000 of tip income if your income's below $150K if you're single, $300,000 if you're married joint. They do have provisions in there that it's only for industries that traditionally receive tips from 2024 and back. Because all of us business owners are like, hey, let's just start tipping our employees, right?
Yeah.
And so you'd be tax-free for them. So they've got language in there that that's a no-go. The IRS is going to issue guidance by October 2nd of this year, and with some specific industries identified. The food service, taxis, hair salons, whatever list, they're going to give us that list by October. And whatever reporting requirements are going to be needed for the payroll companies.
That's
the no tax and go ahead.
Sorry to stop you there, because on one of those channels you're talking about that says blah 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 blah, they talked about that they're like, well, they're just going to pay in tips or whatever, but there's actual wording in there that protects that.
Yeah, and when Congress passes something, the wording's pretty general and not, they put their intent in there, but they don't prepare tax returns. They can't really think through it, and especially tax strategists, they're already trying to figure out ways to best optimize that. I'll use that word, rather than exploit. And So then it's the IRS's job to pass either regs or just general guidance, on how to implement it. So they're going to give a list by October 2nd. They just issued that a couple days ago that it's forthcoming. And the other one is overtime, right? And so you can get a deduction up to $12,500 of overtime, and I think you double that if you're married joint, and as long as the income's below 150K single, 300K if you're married. So that's a good amount of tax-free overtime, and that also is just in place for 4 years, 2025 through 28. The big thing there, anybody that's an employer and has employees, there is going to be a new reporting requirement of what that overtime is, and this needs to be overtime is currently defined in the Department of Labor laws, and it has to be overtime, not straight time, but it has to be higher than their regular rate, i.e., time and a half or double time. So that's a big deal, and
Nice.
certainly with my admin team, they have some overtime during busy season.
Yeah. I do have a question about the tips thing. Because I
Sure.
was a server back in the day. You were as well. And, we've had other siblings and family members, and my kids have been servers. And, they don't report anyway.
Right.
Right. Yeah.
Tips.
There's certainly more of it reported these days because it's credit card at most restaurants
yeah,
rather
that's
than
true.
cash. But it may be tip pool. But you're right. The 20 on the table, that was never taxed in the first place, right?
No.
Now, of course, we did the right thing, I'm sure. My memory
Sure, yeah.
fails me. I don't remember exactly. But I wonder if this is even more than a campaign promise that they're trying to come through on. Is this a way to get data on how many tips aren't reported so that 4 years from now they actually have a benchmark?
Yeah, who knows? Who knows? Right now, if you report tips, this was several administrations ago. They did create something called the tips credit that restaurants get if they actually report tips and pay, send taxes on it, Social Security tax and whatnot, because they've been always trying to incent it. Now with more credit card data, right, more tips are hitting the books than they used to.
Yep. I hadn't thought about the credit card thing. Okay.
Yep. But yeah, if you're in a cash restaurant, there's no way.
No way. No. When I was working as a karaoke host, the owner, I won't say where it was. The owner would pay me in cash. I would just have a fixed price every night. I come in, they pay me in cash. All my money was made in that tip jar. I made so much cash money. And
Yep.
I remember.
yeah. Oh yeah, of course.
Yeah, I was there twice.
Yeah. And I remember I forget what our big beautiful bill told me about that. I was like, what do I do about taxes if this is the most I'm making? I forget. Let's move on.
Okay.
Yeah, exactly. Yeah. No, it's cash businesses are outside the economy, right? Outside the reported economy. Now, the one other campaign promise was no or deductibility of car loan interest. And this one we're going to need more guidance on, and the IRS has promised this guidance by October 2nd. So it's another 4-year deal, and saying that if you buy a car that is considered American made, so the IRS has got to come up with this list, then you can deduct up to $10,000 of loan interest. So a couple things have to happen here. Number one, you got to buy it in 2025 or later, right after December 31, 24. So it's a car bought this year. It has to be determined American made. The IRS is going to come up with the list, and then they did say on the tax return, you will have to enter the VIN, the vehicle identification number. And then it's only incomes for $100,000 singles and below 200 if you're married joint. And the other thing is they're going to have to issue new rules on how the auto loan, the lenders for car loans report interest. Because currently, because it's not a mortgage, that is not currently reported to the IRS. So they got to get that figured out for this year so they can match it. So that's coming up.
Nice.
What?
Yep.
Oh, I had a question. Does it have to be a new car? Could it be a used car?
I believe new, but that's a good question. I think it is new.
Okay.
Yeah, and then purchased after 2024.
Oh, okay.
Now,
Yeah, but I'll have to double check that and verify.
I actually had that question too. Yeah, go.
We
Yeah.
had our buddy James Bean on here talking about 1031s, and I don't think the bill did anything with 1031s except
Nope.
that it didn't do anything. Like it didn't cut.
Right. Yeah. Yeah. The big news there, it's alive and well, right?
Yep.
And because there was under the previous administration when they had power, there was for a bit a version of a bill that was threatening 1031s. Yep.
Seems like
Yep.
every administration always puts those on the block, and then nothing ever happens.
Sometimes, yeah, there was certainly the last time it came up. 1031's been around a long time and was considered safe, and that was concerning. Actually, it was candidate Harris. She was the one that proposed it. That never did come out of committee in Congress. So I guess we need to specify that it was in her plan, but no one in Congress in Ways and Means or the Finance Committee had proposed that. So that is an important distinction. But the biggest fight of all, if there are any more questions, we can get to the biggest fight of all in the bill.
Oh,
Yeah, let's hear about
Well,
the drama.
I do have a question. Well, maybe we can just do a Q&A whenever we're done.
Okay,
Sure.
Yeah,
Yeah.
go ahead. Let's go.
So the big one that was one of the more interesting things to follow was the SALT deduction.
Okay.
And
Salt?
yep, SALT, which is the
State
state
and
and local tax deduction, how much you can deduct on your personal tax return. And so what you had is the Republican Congress people from New York and California were really pushing. In any, regardless of party, anyone in a high tax state has been pushing for this. And so big fight in the House, and that's what, one of the reasons that it barely passed, because you didn't have everybody on board. Some wanted it completely restored to the old days where you could deduct it all, but they left out the detail that there used to be something called alternative minimum tax that was so tight that, people, if you had a really high state and local bill, you actually didn't get it anyway. Little detail that's been lost. So it came out of the House of Representatives with a $30,000 SALT deduction. And then headed to the Senate, and many of the senators said, no, we're not raising this from 10 grand at all. Why should someone in a low tax state pay more federal tax than you in the high tax state just because our state doesn't charge as much, right? Why someone making, if we're both making 200 grand and, why is the person in New York paying less federal tax than the one in Florida or Tennessee?
Hold on just a second, Kev. Does this land yet? You've got that look on your face. Okay. Let's say you live in California and I live here. We both make 200 grand.
Okay.
Okay. I'm paying income tax in Kentucky at like 5% or whatever. And in
That's
California, I don't know. What is it like?
It goes as high as 13.9.
13.9. Now,
And we haven't even gotten to property taxes yet.
right.
Yep.
So you get to deduct what you pay in state tax
Okay.
off your federal income tax. And I do too, except I've paid less in state-wise, and so my deduction's lower. So I'm paying more federal income tax because I pay less state tax than you are in California. And like the senators are saying, why? Like we get to choose where we live. That's just the cost of living in California. Like why should you benefit because you live, over there?
All right.
You know, that was the issue.
Yeah.
Yeah, and so the ideology, and they're saying, hey, all this does is encourage higher state taxes. On the other hand, the reply from the Congress people knows that, like, hey, if we don't do this, we will not be reelected, and we're going to lose your majority, right? So both are true, right? Yep. So anyway, you can see why this was so contentious.
Yeah.
So it goes to the Senate, and many were absolutely threatening, and it appeared that it was not going to go to 10 grand. But the 10 grand that we currently have, and somehow it came out of the Senate not at 30K, but increased to 40 grand. So that was a surprise.
Wow.
And I do know there was a congressperson in New York saying, hey, there's no way I'm voting for this thing if it's not at least 40. So obviously discussions were had. I know the president got involved. So this just goes, it's temporary though, because this is an extremely expensive part of the bill, very expensive. And so it goes through 2029. It's going to be 40 grand effective this year. Then it's going to go up 1% a year. So that means in 2026, you deduct 40,400. So that's where we're at. Now it is means tested. I think it phases out once you're married filing joint, your income hits $500,000, is my understanding. The other big news is regarding SALT is there's an election we do with our clients, and hopefully your CPA is doing it with everyone here, that if you have an S Corp or partnership with taxable income, you can pay your state tax through your corp. We do this with you, Bo. And that's called the SALT PTE election, which stands for State and Local Tax Pass-Through Entity. So if you're not doing it, everyone get with your CPA. Well, when they're figuring out how to pay for the super expensive, SALT increase that we just talked about, one of the ideas was like, all right, let's get rid of the SALT PTE, and you just get what you can on your 1040. And those of us that were gonna, really rely on this deduction and we're gonna, be phased out by the income thing, we were kind of freaking out. And this is the one case where the AICPA, our association, the CPA lobbying firm, actually really got to work and actually won for the first time ever that I can think of. And so then they came back and said, well, maybe we'll keep it unless you're an SSTB, meaning the lawyers, doctors, and CPAs. And that hurt my feelings too. But anyway, it came through unscathed. It's still here, and I'm still celebrating because that's worth a lot of money. So that was a big fight. Now, so SALT to be continued, and that goes through 2029. Now, what I will say is SALT is desired by, that deduction is desired by not just the blue state Congress people in the Republican Party, but is pretty universally liked by the Democratic Party. So even if they're in power or divided government, there is a legitimate chance that this gets extended in 2029. And when you have popular deductions or credits, history does show they tend to, once you put them on, even if they're temporary, they often find a way to get continued.
Well, I know that you've got a hard out here in a couple minutes.
Yeah.
Is there anything else? And I know Timmy's got at least one question he wanted to throw at you, but.
Yeah, I got one interesting thing to add. And this has gotten very little press on either, the left or the right, news networks, depending on where you consume your news. They actually brought back limitations on itemized deductions for people in the highest brackets. So again, a lot of these giveaways and new deductions are for the lower incomes, and they actually did raise taxes on people in the highest bracket. So when you hear the spin that this bill was only for the rich, it's not the case. And here's a prime example. So in the old days, prior to 2018, you had something called the piece adjustment, where it limited the amount of itemized deductions you'd get, and it added a couple points to your effective tax rate. So the deal is here, if you're in the high bracket, first of all, they added a floor for charity, that you only get charitable deduction to the extent it exceeds 0.5% of your income. I think it's anyone that itemizes, actually. And so if we give the example, if someone's making $1 million, they would only get charity to the extent it exceeded 0.5 of that, i.e. $5,000. And then the second thing they did is any itemized deductions that remain, you're only getting the effective rate of 35%. So they came up with this equation that says you got to take your itemized deductions, you multiply it by 2 divided by 37. That gives you a limitation, limits the amount you can get. So if I give an example in my webinar, if you got someone making $1 million and they've got $100,000 of itemized deductions, and in there you've got some SALT and some charity, maybe some mortgage interest. First thing that happens is you're going to have $5,000 lopped off your charity, because you got to get above 0.5%. And then when you apply this 237th haircut, people are trying to come up with a name for it. That's going to knock off another $5,400. So in effect, a little over 10% of your itemized deductions, if you're in the high bracket, are going to go away. Is how the math's going to work. And that'll add, a little less than, 0.4%, about 0.4% to the high income people's effective tax, both effective and marginal tax rates. So there's actually a little increase on the highest incomes.
All right.
Yeah.
Yep.
Interesting. Yeah, I hadn't heard about that at all.
Yeah, no one is.
Yeah, and it's not the most exciting stuff.
Yeah,
nobody wants to say 237th on TV.
Yeah, it's complicated. It's a lot easier to get our heads around bonus depreciation, right?
Yeah. 100%.
And QBI, yep.
100% bonus depreciation permanent, right?
Yep.
Yep.
Permanent. Yep. Permanent tax rates, permanent, QBI, that Section 199A, permanent bonus depreciation. I mean, we got some really good things in here, and I really think it's going to help the real estate industry a lot. I mean, it needs it. It needs it. Now we just need low rates, right?
Yep.
Yep. Interest rates go down. Did you have a question?
So this is from James. He said, this may be better for Bo, but do you think the modifications to the opportunity zones will actually spur new development, or will it continue to be stagnant as it has been?
Well, I would say it's been stagnant lately because you're kind of at the end, you're at the end of the tail. Like there's not a lot of benefit left.
Right.
So restarting it, I would expect to actually help things because you saw some pretty good deals happen in these opportunity zones, and I think they were, at least in some places, effective. Like it drew the capital and the improvement that they were hoping to draw in some places. So this gives states another opportunity to try to recast it. And once it's recast or redone, or I don't know what the right word is, there are real benefits. There are real tax benefits and other benefits to doing an opportunity zone deal. So yeah, I think
it'll probably go a little better this year for a few reasons. One, we've got a year and a half lead up for people to get their funds together, and get things organized. Secondly, now we know how this stuff works, kind of, and as you mentioned earlier, they improved the rules. You don't have to put 100% improvements in anymore. I think they lowered it to 50 and 50%, something like that, and I think it'll go better than it did. But there was a surge at the beginning of the last time, and this time I think there'll be a similar surge. But you've seen nothing lately because why do it, right? It only you don't lose, it doesn't get rid of any gains, and all it does is kick it to next year. So I think it'll be totally stagnant until 2027.
Well, Kevin, I know you got to go, but thanks so much for coming on, and thanks for
our pleasure. Yeah, and as we get more details, I'll keep you posted. So IRS has got a bunch of guidance that's going to come out. They said by October 2nd. That's what they've promised, but this is interesting stuff, and really going to keep our eyes on this. What happens if you build a factory? That could be something we've never seen before.
No kidding. Now, before you go though, tell people where to find you.
Yeah, so we're at BassettCPAs.com, and we do webinars and whatnot. Our big thing with our clients is we keep them educated, and there's just so much good stuff here, lots of opportunities, and let's go get it.
All right.
Yeah. So on there, if I wanted to get if I want to be a part of one of those webinars, I would just go to BassettCPAs.com. Is that right?
Yep, that's right. Yeah, and let us know. Get on our contact list. We send out anyone can be on our contact list, and we send our tax alerts and invite you to some of the free webinars and love to. And we only do paid webinars in October every year because those require a lot more work. And yep, love to have folks on and teach them how to optimize their taxes. Right, we're tax strategists, so we love what we do.
Yes.
And I can tell you from personal experience how valuable they've been for us in our business. So not just an interesting CPA who knows what he's talking about. They're actually good at what they do.
Absolutely. If you see on the screen right there, you could click that. It'll take you right to Bassett and Associates, and you could sign up for his webinars. Kevin, this is amazing. I loved seeing how excited you were.
Yeah.
Today. I can just tell you're ready for this and excited to see what more comes out. Thanks again for doing this. Can't wait to talk to you again. I'm sure as these come in, we'll have you on a little bit more frequently.
Yeah, I'd love to have. I always love joining you guys. And if there's something good to talk about, I'm here. Let's do it.
And I know you have to bounce, so feel free. We're going to kind of wrap it up here, but no need for you to stay unless you just want to hang out and be late for your next meeting.
You got it. All right. Thanks, guys.
All right. Thanks, Kevin.
Have a good one. See you.
Bye.
See you. Bye.
I'm sure you've got some thoughts, and why don't you break it down for me a little bit?
Okay, so a lot of the things that we really love about commercial real estate is not only that you can put your dollars to work and earn a good return, but there's some tax benefits.
Yeah.
So you can do a cost segregation and break out some of the value of the building and depreciate it faster. You can then apply bonus depreciation to that. And for a number of years, you could bonus depreciate 100% of that in the first year. So you could literally go into a year saying, I project that I'm going to make this much money this year. And if you're a real estate professional, you could then calculate how much commercial real estate do I need to buy this year so that I can cost seg it and bonus depreciate,
Right.
and get my taxable income down to zero or at least the bottom tax bracket.
Right.
I mean, it's how much do I have to buy to pay almost no taxes?
Yeah.
Like, that's a weird way to think, but commercial real estate gives you the ability to do that if bonus depreciation is in place.
Right.
Now, when you sell this stuff, there's cost recovery. You got to pay back 25% of what you depreciated. So it comes back around in the back end, and that's where you might want to look at 1031s or some of these other strategies. But man, that 100% bonus depreciation being back is a huge deal. It makes commercial real estate for a high net worth investor so much more attractive because they can shelter so much more of their income. And if you're not a commercial real estate professional, and there's specific rules. So I think you have to spend 50% of your time in real estate.
Yeah.
And it has to be over 2,000 hours in a year.
Right.
Okay. So if those two things are true, then you're a real estate professional, and this bonus depreciation, those losses that are created, can offset all of your income.
Yeah.
If you're not a real estate professional, you don't qualify with the hours or the 50% of your time, then you can wipe out all of your real estate income.
Yeah.
So all your passive income or your real estate income you get from rentals or what other things you're invested in, it can wipe all that out.
Wow.
And then what's left over, you can carry forward to the next year.
That's right.
So you still get to use it.
Rollover minutes.
Rollover minutes, baby. That's right. That's what we said. So that being back makes commercial real estate way more attractive and should incentivize investors who are looking at deals thinking, money's just so much more expensive now with the interest rates higher.
Right.
I mean, they're over double when we were doing deals 3-4 years ago. The interest rates are over double. So it costs just so much more to borrow the money to do a deal. And so the returns aren't where they were. Well, now with bonus depreciation, there's a whole other reason to maybe go ahead and do a deal that you wouldn't have done otherwise.
Right.
So this should create more demand, which will make brokers happy, which will make sellers happy, because more demand means it should help prices rebound, because prices have been going down across the board, across the country. So just this one thing of bonus depreciation could have a ripple effect where more people are going to be interested in buying commercial real estate, demand goes up, prices can start to go up or at least go down less, which is good. All of those things are good for the commercial real estate industry.
Remember I think it was one of our very first episodes, we talked about bonus depreciation and cost segregation.
I think it was our second episode.
I think so.
On tax, yeah.
Yeah, it's just crazy now coming back around. Because I remember talking about the sunset and understanding cost segregation, and it's just so clear because it was our second episode.
So if you'd like to learn more, you can go back to, I think, to episode 2.
Episode 2.
And watch that. We break all that down. All that stuff will still apply, except then we were talking about how it was phasing out. The bonus depreciation part of it was losing 20% of its power every year and sunsetting.
And now it's permanent.
Well, until the laws change. But yeah, there's no sunset provision in the law. So it just, and that's possible. Sorry, hold it. That's possible because we've got the Republicans have the House and the Senate, probably, right? Trump was able to push through his version of the bills, and because they controlled all three, the White House and both chambers of the government, they were able to get it through.
Yeah. All right. What were you excited about?
Well, man, you add in this idea of manufacturing property,
right?
That you could depreciate just the whole thing the first year.
What? Oh.
Not just 20 to 30% of it. Because look, bonus depreciation only applies after you do a cost segregation study. And what a cost segregation study is it breaks out everything that's not real property, and it identifies what's personal property. Well, you can depreciate personal property quicker.
Right.
On quicker schedules.
If I remember correctly, it's like somebody comes in and they're like, okay, the carpet here has a life.
A much shorter life than the building itself.
The building, yes, okay.
The landscaping, same thing.
Yeah.
The seal in the parking lot, same thing. Wallpaper, same thing. It's like they break apart the building and they put all the components of the building on their appropriate IRS-defined depreciation schedules.
Yeah.
And the personal property schedules, I think, are 5, 10, and 15 years. So you take the stuff in the building, and some of it goes on 5, 10, 15-year cycles. Right. The bonus depreciation says that everything that goes in the 5, 10, and 15-year buckets, you can just take it all year one.
Right.
So most of the time when you do a cost segregation study, you can get 20 to 30% of the value of the building taken from real property and put it on the personal property schedules.
Right.
And then that's the 20 to 30% that you can bonus depreciate in the first year. Now, if it's a manufacturing building, and again, he was real specific. Like, we don't know how this is going to play out because the bill said this, the IRS has to come out with the rules on how this works. But whatever manufacturing ends up being, you can depreciate the entire building.
Yeah.
In year one.
100% of it.
100% of it.
That's nuts.
Now, you've never been able to depreciate land, I don't think.
Yeah.
So you buy a building for $1.2 million, 200,000 of it is the value of the land, and $1 million left for the building.
Mm-hmm.
You could take $1 million in depreciation in year one.
Because they're trying to get a more manufacturing to happen here in the States.
Yes, they're trying to reshore. That's a huge part of Trump's agenda. Reshore. I was just listening to a podcast with Governor Perry and former Governor Perry in Texas.
Yeah.
Is it Perry?
I don't know. I don't know the governors in Texas.
I think it's Rick Perry. Well, he was the energy secretary, and they're doing a big project for AI, world's largest data center,
right,
and nuclear power to supply the massive amount of energy that you have to, so that they can beat the Chinese.
Right.
Big. So there's, the Trump administration said, go beat the Chinese in AI. We're going to reshore manufacturing. We're trying to get those jobs back and that work back so that we're not depending on a global supply chain that could break down. And now we can't manufacture. Well, like, we don't manufacture our own meds.
Right.
Or our own PPE. We saw what that looks like. And so whether you like it or not, what Trump's trying to do is get all that back here.
Right.
A lot of that manufacturing back here.
Yeah.
This would be very much aligned. Like, there's a huge, massive incentive for the commercial real estate industry to throw money at factories, manufacturing. And that's very much aligned with what they're trying to do. So that makes a ton of sense. But, like, man, I'm real interested to see how that plays out.
I want to talk to Chad Griffiths right now about this. Wouldn't he just be flipping out over I mean, he's Canadian, but even still, how excited with that?
Yeah, we should.
Because he's all about, we should get Chad Griffiths back on.
Yes, immediately.
Immediately. Chad, I know you're going to hear this. I don't know if you're here live right now, but let's reach out. Let's get him on immediately.
Yeah.
Yeah, because that's 100%. He's probably super jealous. Super jealous. Yeah, because he's Canadian.
By the way, I'm not a fan of electronic vehicles.
Okay, tell me why.
I don't even think they're good for the environment.
Is that why you don't like them?
I think they're ugly.
The truck is ugly.
Oh, that Cybertruck.
But some of the other ones are kind of cool looking.
I think Tesla's sedans are cool looking and stuff.
Yeah.
But the manufacturing process to create the vehicles, you have to drive them for 7-8 years before they become carbon neutral.
Sure.
So, and rarely does anybody do that. And then it's like, how do you dispose of those batteries? How do you, it is not, based on what I know, and I've studied it a little bit, okay? And I could be wrong about this. And if you want to send me hate emails, fine, go ahead. I'll have Alice clean them out.
Yeah, and plus, a lot of people, you be careful, because people are setting electric vehicles on fire, so.
Oh, yeah, let's not do that. I'm not suggesting that. But look, I think they're bad for the environment. I should say, I don't think they're any better for the environment than any other vehicles that we have out there.
Yeah.
I don't see the benefit.
So if I'm getting you right, you don't like the fact that people are saying it's better for the environment and it's not.
Yeah, it's complete.
And so you don't
BS,
like electric vehicles, but mainly for that reason.
Yeah, I don't think.
Yeah.
Now, if you just like them and you want to buy one, you just don't think you're making the world a better place by doing it.
Oh yeah, fair enough. Fair enough.
That's what
I'm totally
saying.
down with that. Fair enough.
I don't care what you drive.
I do want to get in a Tesla and have it drive me around and go from 0 to 60. And
I have had Tesla as a rental car before, and it was fun to drive.
Yeah, so you do like electric vehicles in that sense, is that it was fun.
Yeah, I think what you're trying to parse here is all the marketing and propaganda behind EVs are better for the environment. I think that's complete BS. So that's what I mean when I say I don't like electric vehicles. Otherwise, I don't care what you drive.
I'm with you too.
Just don't think you're doing us a favor.
Yeah, but I think to drive a Tesla would be
pretty cool.
Yep, that's right, Michael Hieronymus.
All right. I was just with him in Portland last week.
Well, we've got a few.
Not Portland. He's from Portland. We were in Minneapolis.
We got a few really
You
good.
didn't say show me some skin. I was disappointed.
Did you hear that?
Yeah.
You didn't say show me some skin. I was disappointed.
Anyway, okay, cool.
All right, let's wrap this up.
That was it?
I think that's it. I mean, we could continue
No, I
to
mean,
talk about it, but that's the main thing, man. That bonus depreciation and then the manufacturing piece could really, really change things.
yeah.
Might even have some unintended consequences by spiking demand so much that it drives prices up and makes these deals not make a lot of sense.
Right. Well, a few shout outs. Rod, Santo, Massimo has been on here. James, Appalachian Commercial Real Estate. James, good to see you. Thanks for the question. Shout out to Raphael Chiazzo.
That's James Milner.
James Milner. I know. Yeah. James Milner. Raphael. Shout out. Jay Barron. Welcome back. Thank you so much.
Brother.
And Jay saying you're right, Bo, about the electric vehicle Cybertruck. Emoji.
So ugly.
Thanks for that. Everyone tuning in live, thank you so much for doing this. We wanted to jump on here.
Man, you are leveling up here.
Yeah. It's hard to listen, though. I got to get better at these lives. Doing this.
Well, you're doing a lot over there. I mean, you had like, breaks it down for 2. Like you're doing the stuff on the fly. You even provided a link that people could click on.
That's right.
That's impressive.
That's right.
I see what you're doing over there.
Yeah. I'm glad we didn't do a
Quiz.
Quiz, because I would not have. Anywho, before we file this episode under capital gains, here's what you need to do. Number 1, smash that follow button like it's 2017 bonus depreciation loophole. Number 2, leave us a 5-star review on Apple Podcasts, because this show is basically emotional income and we are very tax efficient.
Also, if you only leave 4 stars, Timmy's going to 1099 you out of spite.
You will be issued a W-2 for wasting our potential.
Yeah, that's not how it works.
Well, neither is real estate, and yet here we are.
Anyway, sign up for our newsletter at subscribe.wgbaron.com.
It's packed with our latest episode, articles on leadership, negotiations, business strategy, all the things Bo reads that earn him my utmost admiration.
And everything I wish I had when I started in CRE. No fluff, all value.
Also, if you're drowning in emails, data entry, and back office chaos,
Like trying to 1031 your sanity.
yeah, then you need a virtual assistant. Go to superpowershq.com/commercially speaking. You could click that button right here, right now. That's where Bo found Alice, and trust me, she's been depreciating his chaos since day one.
They'll help you reclaim your time, scale your biz, and even get Timmy to respond to your emails.
Which is actually kind of amazing.
Yeah, it is.
Again, for those in the back, that's superpowershq.com/commercially speaking. And now, Barbara Corcoran. Barbara Corcoran, if you're still with us, I've got one word for you: depreciation. It's not just for buildings. It's what happens to me emotionally every time a broker uses the phrase off-market opportunity. But here's the thing, Barb. This podcast, it's a write-off for the soul. You don't even have to invest. Just show up in a power blazer and explain to me why I'm a limited partner in my own potential.
Oh, no.
We are the asset, and girl, we're cash flowing.
Timmy, say goodbye.
Okay. This has been Commercially Speaking. Thanks for listening. Thanks for subscribing. And if you learned something today,
You owe Kevin Bassett a big thank you and probably a retainer.
we'll see you next Tuesday. I love you, brother.
Love you, brother. Bye, Alice.
Let's see. There you go.
Still here.
You didn't say show me some skin. I was disappointed.